Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, October 12th, 2021. What we're seeing now is yet another sort of meandering market. What I've noticed over the past couple of days, and this is something I think that particularly the trading types among you need to be cognizant of if you're not already, is what I'm calling the daily opening, pre-open, information-free ramp, for lack of a better word. Basically, I've noticed this pattern over the last few weeks. Sometime, let's call it between 8:45 and 9:30 Eastern Time, we see the futures just mysteriously tick higher. It's not like there's any reason. Obviously, there are some days where the futures do what they're going to do for good reason. Last Friday, they did what they were going to do because of the economic reports. But on a day like yesterday or a day like today, where there really wasn't anything meaningful on the economic front, we just saw the futures sort of climbing higher as we went into the open for no apparent reason. And I'm sorry, things do move usually for a reason. And I think that reason is that there are futures traders out there who think that they can kind of sucker other people into a ramp. I'm sorry. And I don't want to see any of you played for a sucker. Yes, there are certain times when the markets are going to move and they're moving higher, and it, by all means, jump in, because there are a lot of times very good reasons why markets do what they're going to do. But what I'm noticing in this pattern is we're just sort of seeing the futures open higher, well, sort of drifting in the morning, then sort of catch a bid, and then the bid grows, and then it sort of follows through. Now, yesterday's trading, that pretty much followed through till about 11:30. We were up, good 20, 25 points in S&P. Before giving it all back and then really falling out of bed late in the afternoon. Now, it was a semi-holiday here in the U.S. And a holiday in Canada, and so we didn't have the level of participation that we often do. Certainly, we didn't have any signals from the bond market, but that was a bit of a disappointment in yesterday's activity in the afternoon. The morning, again, it didn't surprise me that we came off the morning highs. There was no reason why we were 25 points higher. It just struck me as part of the ramp that we were seeing. Today's attempt seems to be a bit less successful. They tried it. They got it up about 10 points pre-open, which would be somewhat logical. I think there would be some buy the dip activity, despite me warning about that last week, that buying the dip may not be as good of a strategy on a reflexive basis as it has been. Again, for the last year or so, you can pretty much close your eyes, buy any dip, and it would work out for you. I don't think that's going to be the case now, and we've gone through the reasons. And if you haven't seen them, the links are all over Traders Insight. Basically, it's saying that the Fed is not the tailwind that it has been, and that's not even to mention the fiscal policy, which is at best murky, at worst a mess. But basically, remember, when you throughout most of the last 18 months or so, you knew that the Fed was going to be coming down the pipe with more money, and I think you can't take that for granted anymore. I elucidated this to great extent yesterday about why I think the Fed has no choice but to recognize that their bond buying activity is going nowhere. All it's doing is turning back up at the Fed's reverse repo window. I'm not going to belabor it here. I encourage you to read what I wrote yesterday. It was called Pushing on a String. And I also encourage you to read what was posted on Traders Insight, but what I wrote for Barron's last week, that buying the dip may not be the strategy that is so workable anymore. Actually, I do mention in there that I think the one strategy that might be a bit more tenable right now is buying dips and VIX, because I think what we're seeing here is I think we're going to see a more volatile environment. It's going to be more uncertain. We know that the Fed is not going to be as solicitous of just small market downturns. It's just not going to be this wave of money coming. When you have greater uncertainty, it leads to greater volatility. In terms of things that can induce volatility, we have earnings season beginning this week. I've stated many times that I'm not a big believer that banks are a great bellwether to earnings season. They're quirky, they're idiosyncratic. Um, their trading numbers definitely, analysts can, sort of selectively utilize them as to the health of the bank or the markets or the economy, and ignore them when they feel like it as well. Those earnings blew it away, but they made too much money trading, so let's not count that money. So you get strange things in there. What I think you do want to listen for is, do some of these bankers to large corporate customers see any trends that are developing in terms of their customers and how they're dealing with the supply chain issues, inflationary issues, et cetera, that may be weighing upon those companies, and that will get a clearer read on as the weeks come, as we see industrial earnings and tech earnings coming out in the weeks that follow. So don't read too much into the bank earnings. The other, of course, volatility-inducing thing that we could see this week is a monthly expiration. I don't necessarily see any big trends right now leading into it, except for the ones that we've discussed, which are already pretty big. But I think the move we saw yesterday, the fact that we just kind of fell apart late in the day, was possibly emblematic of that as we get into a more volatile week. The thing I want to take away here is I've been doing some chart work, and remember that we are trading basically around the 100-day moving average. And I have noticed that the 100-day moving average still remains pointing higher, as does the 200-day moving average, which hasn't even been touched for over a year. But about a year ago, we did have a test of the 100-day moving average, and the markets, as we can gather, passed. As of now, it's having a tougher time. That last test lasted only, a few sessions, 3, 4, 5 sessions, and then before we lifted higher, again, on the back of relentless fiscal and monetary stimulus. Now we seem to be meandering a bit further. I'm noticing some of the longer-term averages starting to turn lower, 30, 50-day, that kind of thing. Not longer term, but medium term. And this feeds into my idea that volatility may be around, uncertainty may be around. Uncertainty and volatility go hand in hand. And why I think there's still going to be opportunities to make money in this market. I'm not sitting here saying, run for the hills, but I think you have to be much more selective in terms of what you're going to be buying, if you are inclined, if you're staying long. And reflexive buying is not necessarily the way to go. So on that happy note, have a great day, everybody. Take care. Bye-bye.